Good afternoon, friends. Generally, first session we have to ask that. Second session is all right. After the break, it is all right. Everybody is all right. Pritiven, other office bearers of WRC, and friends. Many times our colleagues ask me, why do you go so regularly to WRC programs? I said there are three reasons for it. One is I meet so many of our friends, which I am not normally able to meet. Secondly, I refresh my knowledge, because truly refreshing, because at least I studied those topics. And third, I say, I feel young. When I come to among the youngsters, I feel young. So therefore, I'm here with all of you. I was just telling Preeti when I said, I remember my association or with the WRC or for DTRC right from 1978. That was the first time I addressed WRC at Patkar, then Birla, then so many places. Now we are close to here at Yogi. So therefore, always pleasure to be here to share our thoughts, learn ourselves from the interactions what we have, questions what we get, and enrich ourselves. I think that's how I look at these programs to when we accept invitations to come for any programs. Now, we are really thankful to Institute and WRC and many other organizations for doing so much of academic work. I think each one of us owe our responsibility to pass on whatever we learned from the Institute, whatever learned from practice, to the younger generation, so that at least the Guru Shishya that must continue. I'm not saying I'm Guru, but I'm saying at least we can definitely share with our colleagues whatever we have learned from each other, what we have learned in our practice, for our whatever 4 or 5 decades of our practice, what we learned, share with all of us, all of you, and in the process, learn from the same things. I think that's the way I look at these programs, and I'm here with all of you. Friends, from the topics you'll notice is a quite vast subject. So I asked few of my friends and colleagues as to what topics or what decisions we should select for the purpose of today's presentation. So I have shortlisted based on those topics as to what would be interest to all of you, what was interesting to me, as well as what would be topical or practical use for everyone. I think that is the purpose which we have selected. Not that all the decisions will be able to analyze in detail and see the repercussions of all those decisions. But my purpose is to at least highlight some of the silent features of those decisions and how we could make use of those decisions for our day-to-day practice. I think that's the purpose of the selecting of some of the cases. I'm not sure whether all issues will interest you all, but I thought this could be, at least for majority, these issues could be useful, so therefore this is how we selected. Now, first topic which I have selected is taxation of real estate transactions. And those who are having clients who are real estate contractors, real estate developers, I think this issue becomes very, very critical. And particularly the view which department is taking and the way they are litigating the matters, this becomes important for us to understand and refresh what the topics are, what is the issue which we need to understand from this point. Now, as all of us are aware, when we talk of real estate transactions, there could be two sets. One could be real estate contractor, who is pure contractor. His job is to construct as per the specifications given and complete and give it to him. Other could be real estate developer, promoter developer, whatever we call it, promoter developer. Again, in promoter developer could be two classes. One is who does the large projects like townships, and one who does the smaller projects, 1 building, 2 building, 3 buildings. So that's a second segment. So question is, how do we determine what is the correct accounting principle for him and how income should be taxed in those cases? I think that's the issue which is there. Some of the cases what we had occasion to go through, we have noticed that most of the cases, assessing officers are taking a view that completed contract method is no more permissible for the purpose of real estate developers also. Contractors is separate, but real estate developer, that is not permitted at all. how far that is correct, not correct, what is the judicial precedences, and what is our institutes or accounting standards say about this. I think that's the point I just wanted to highlight to all of you. Now, as those who are in practice for longer period, they will know we had accounting standard 7 first, which talks about construction contracts. And there allowed both percentage, which came in 2007. It allowed both the percentage completion method as well as project completion method. And it was applicable to both contractors as well as real estate developers. Thereafter, there was revision in 2002, and only percentage completion was allowed, but it was made applicable only to the contractors. So it was not applicable to developers. So that's a distinction made in 2002 itself. Thereafter, AS 9 was made very specific, and para 10 and 11, which is very interesting paragraphs. I think those who are confronted with this litigation should go through that paragraph very carefully. That has said what is the revenue recognition, how revenue recognition to be done in case of real estate developers. And expert advisory committee also clarified that this will 9 and 10, para 10 and 11 will apply to real estate developers. So therefore, that clarification has been given by the expert advisory committee of institute, and that has been followed by everyone. Thereafter, AS 11 came, which is succeeded by IND AS 115. What it says is, real estate development or developer is nothing but a good or service is considered to be transferred when the customer obtains a control over the assets. Now they have gone to the extent of saying that this is nothing different than handing over of goods or services to the customer, and he gets the right over that whatever we are passing on to him. Now this is the principle which they have laid down. Theoretically, IND AS 115 is not applicable to all. It is applicable to only certain categories of taxpayers or contractors. That is about 250 crores, or it should be listed on the stock exchange. So that's limited. But the principle, what has been laid down, I think is interesting to understand. Now let's analyze the situation. Suppose there is a contractor who is doing the contract work. What is the option for him? He has to follow percentage completion method for a reason, because his revenue accrues as soon as he completes certain percentage of work. So that is, I think, goes without saying. In case of contractor who is not a developer, should be followed percentage completion method. But take a situation of a developer-builder, and suppose he is doing a township. Let's take a situation of township, 100 acre, 200 acre, he is doing township. How will he account for income? If he is going to follow this principle, does it mean that he has to postpone the income offering for taxation right up to the entire project is completed, or he has to go to the respective completion of a respective project? I think that's a finer aspect we need to consider. Take a situation that he does in the phase-wise. Suppose first phase, 5 buildings, second building, 10 buildings. So if he goes phase-wise, will he have to offer the income as per the phase-wise completion and obtaining completion certificate? So the principle which need to be considered is, when the work is completed, completion certificate is obtained for the whatever section or whatever phase what you are completing with, is it required to offer the income for that phase? Added to that, if suppose 90-95% of the amount is collected by the developer and possession is handed over, will it not be obligatory on the developer to offer income of that phase, or 5 buildings or 10 buildings which are completed for taxation? My personal feeling is, in such a situation, he must offer income if completion certificate is received, possession is handed over, and he's received substantial amount of money. What is our IND AS says, or earlier AS 9 says, is risk and reward. Risk is transferred, reward is received, then you must offer it for taxation. I think that's the principle. If fundamentally we accept, all other questions will become easier to answer, and it will have to be applied, depends on the facts of each case. Now second case is smaller projects. Let's take a case of smaller projects. Suppose somebody is doing only 1 or 2 buildings. Is it required to offer income every year? Again, I'm saying same principle could be applied, because unless the project is complete to a certain extent, he doesn't know whether he's going to make profit out of the 3 buildings or no. it is not appropriate for him to offer the income, because if you offer first 2 years, third year there is loss. There is no carry backward of losses. So therefore, he will be unnecessarily paying taxes on the income which is never earned on that. So therefore, in such smaller projects also, completed contract method is a proper method for this situation, and therefore, that should be advocated. But when we go to the tax office has a fixed ideas. Every case there has to be percentage completion because you are receiving advance. Their point is, as per RERA projects, you are receiving advance, so therefore you are entitled to. Whether the project is completed, not completed, what is the future responsibilities, liabilities, all the situations are not been considered, and then litigation starts. But at least I am happy that at least tribunal level, these issues are being examined, considered, and accepted. So therefore, if you are caught with some situation, please take it forward and don't allow it to be accepted at a lower level, because this is not the right way of determining. Because many times what will happen is, you offer the income and there could be substantial expenses to be incurred later on. Let's take first 2 years you offer, and third year for completing that project, you have to incur huge expenses. Infrastructure expenses, other expenses, where you will get deduction for that? Because income may not be offered in the third year, income may have come in the first 2 years itself. So therefore, such a situation, it would be always good to plan properly and offer the income properly. There's only one incidental point is, many times questions are raised as to applicability to ICDS 4. If you see ICDS 4 also, ICDS 3 and ICDS 4, that again refers back to AS 9, Para 10 and Para 11. So therefore, this is not something different than, ICDS is not different than anything else. So therefore, that supports our argument, what we are saying, कि ICDS also recognizes कि Para 10 and 11 is applicable, and income has to be offered based on the risk and rewards. And therefore, and handing over position, what is the risk or reward, that is how that they have been accepting. Incidentally, there is amendment in section 43CB, and that has retrospective effect from 1st April 2017. But interesting part, you will say, it says it is only percentage completion. But what is the wording it says? It is for method in case of construction contracts or for contract for providing services. So again, it goes back to the construction contracts and not for developer builders. So in 43CB, in fact, those who want to study a little better, go back to the Delhi High Court decision, which was filed by various associations, challenging the Ind AS when it was brought in. This construction contract, builders' cases were also tagged up with that cases, and Delhi High Court said, no, what Ind AS you have brought in is incorrect. So Ind AS, which was some different Ind AS, they said that is incorrect, therefore it cannot be applied, and therefore they upheld ICDS 3 and 4 with Para 3 and 9 and Para 10 and 11, and that has been continued. And when the section was amended, even section is not amended for construction for developer builders. It only amended for only construction contracts. So therefore, that itself shows department also does not want to pursue that matter to say that developer builders, there is a specific section which need to be applied in the Income Tax Act. Otherwise, they could have made similar amendment along with 43 CB for even for construction contract, which is not done by them. There are several decisions which I think the WRC will circulate this PPT, so those who are interested can be useful for that. Now, second important point along with the construction is relating to unsold flats. Now, those who are aware, there could be two types of unsold flats or rental income earned by developer builders. One situation is, he has a construction ready, but he doesn't want to sell everything today. He wants to sell it off to get the price rise as the project completes. So in between, if the flats are ready, he wants to let it out during that period of completion of construction. What happens to the income of such rent? Is it a business income or is it rental income? That's the first issue. Secondly, there could be developers. Suppose, let's take a situation, he has 5 buildings constructed, but one building he doesn't want to sell it off. He wants to keep it for himself for the purpose of letting. How that should be assessed to. So these are the two types of situations could come in most of the builders' cases. As far as the first case is concerned, where during the course of construction, he has let out part of his flats for the purpose of encashing or getting maximum out of the property what has been constructed by him, according to me, that will be business income. And that there is a judicial precedence to say, in such situation, it has to be treated as business income, not income from house property. But when it comes to the completed contracts, and he has kept his building as a fixed asset, and which is let out for 3 or 5 years, and which happens many times in the case of shops or commercial buildings, they would like to have not sell but make it on the rental basis. That income will go as an income from house property. So therefore, that is a distinction which we need to consider. Also, there is one amendment which has been made which need to be kept in mind, that specific concession has been given to the developer builders that for a period of 2 years, you don't have to offer that income as income from house property, and that is the exception being carved out. But interesting debate happened as to whether this is applicable in case of a situation what we discussed, which is rented out the flats, or during the period of construction. Now, if you closely analyze section 23, it says which is not assessable as a business income. What does that mean? If it is a stock in trade, it will not be taxable as a property income, but it will continue to be business income. So that is the final analysis has been made in these 3 decisions, and they have said that this will be assessable as business income because it may be beneficial in these cases to offer it as business income than take 30% deduction and proceed further. So therefore, depends on the facts of each case, you will have to take a decision where you fall, whether you fall under business income or property income, and amendment which is applicable. And we have taken a view that amendment will not apply in case of a stock in trade. It will apply only when you convert stock in trade into finished asset, fixed assets, and let it out. You will get the moratorium period of 2 years for not taxing it as a property income. So therefore, need to be analyzed. These decisions are very, very good decisions, particularly Kumar property decision, Pune Tribunal, which is accepted in the later decisions. Very fine distinction has been made as to what is income arising to the stock in trade and how section 23 will apply. I think that's an interesting decision to be looked into. Other topic, particularly it has become a hot topic in Mumbai and Thane or certain other locations, is redevelopment of properties. I would say it's a topic by itself. I don't think so we can give answer whether today what is happening, whether it will be one way or other way around, but at least we could analyze what could be the issues arising from this redevelopment activity. Now first, let's take a situation, cooperative societies, and not apartment owners under condominiums under Apartment Ownership Act, because that's a separate, two separate distinction is there, and that we could consider separately. And third is individuals or HUFs giving their property for development. Suppose somebody has a bungalow and that he goes for development, there is a separate section being carved out in the Income Tax Act, and that gives a concession. So we will only restrict ourselves to cooperative societies more, because that's the maximum practical difficulties which are being faced, or maximum queries are being received by all of us from the developers, societies, as to how will it be accessible. Now, question is, when you are entering into development agreement, is it a transfer of land or building, and by whom? I think that's the first question we should ask ourselves. And why I'm restricting to societies, assuming that land is owned by the society. Because answers will change if the land is not owned by society. Let's not get into that. Let's restrict ourselves to, which is the majority of the cases in Mumbai are, land is owned by the society. Now, who owns the land? Land is owned by the society. It is not owned by the individual flat owners. So who is entering into agreement for development? Is it a society or a members? Or both together joint agreements? When you see some of the agreements, builder ensures that all the flat owners are also party to that agreement. He is doing for more safety purpose, but I'll tell you why he is also doing and why it is beneficial for us to get all those flat owners to be signatory to this agreement. My view is, if we look to the section 23, which says, if you are a member of a cooperative society, you will be deemed to be owner of the flat. In that case, you are also owner of a proportionate share of land. So are you not entering into agreement for transferring your share in the land plus the constructed property to the developer for purpose of development? So that's the first question which we need to address. If we address that question or we answer that question, other questions will become much easier to answer. Now let's take a situation little more further refining the question. Suppose in development, I get exactly same area what I was getting earlier. Suppose I was entitled to 2,000 square feet, I'm getting 2,000 square feet. What will happen to, will I be liable to tax for capital gains? Is it that I am surrendering my land and in exchange I am receiving a new flat? Can I be liable to tax on the difference between the market value today of my old building, because it will be whatever discounted 50, 60, 70% of the ready reckoner value, versus when I get a new flat which will be today's market value? Will I be chargeable to tax for the capital gains for that purpose? Time being, let's keep 54 aside. Let's concentrate only on the principle of taxation. That's the first question we should ask ourselves. Then next question is, can we say that I have only authorized the developer to enter on the flat, enter in the building, demolish the building and construct for me the new building? That is why I said if society plus members agree with the developer, that becomes a beneficial for us. So if you are a part of a society, you are a member of the society, and if you agree with the developer, please come construct the building for all of us and give it to back to us. Say, let's say 2,000, I get 2,000 square feet for time being. Is there any transfer? According to me, no. There are decisions against, but my personal view is, when we look at the Income Tax Act, because those decisions are not under Income Tax Act, they are under civil law. Under Income Tax Act, Section 23 itself deems you to be owner. Then can you be said that you are not owner for when it comes to the development of the society? So my personal view may be litigated later on. My personal view is, in such situations, each of the flat owner is entering into agreement with the developer to develop his portion of the property and land and give him alternate new flat in exchange of that. That's not a transfer, because he is only entering into for the purpose of constructing and giving it back to you. When we consider the development cases, I think that's a point which we always used to make, transfer versus development by the developer for you. I think that's the way we can look at it. I think that's a possible good argument to canvass and do a good litigation. Number one. Number two, is society transferring anything? According to me, no. Which is society? Society is consisting of the common name of all the flat owners. So therefore, all flat owners, if they are offering whatever percentage they have in the society, that itself is sufficient to take care. Each of the flat owner is transferring to the developer. Now let's add few more complexities to this. Suppose for 2,000 he is getting 50% extra or 25% extra. Suppose he is going to get, say, let's say for 2,000 he is going to get 3,000 square feet of constructed area. What happens to this extra area, what is getting? Is it to be taxed as a capital gain? At what value? Market value or cost of construction to the developer? Because for him it is a cost of construction. For you it is a market value, because you are getting it the market value of the plant, and because that will be registered as regular price. Though under stamp duty there are some concessions, let's not get into that, but technically ready reckoner value will be different than what you are transferring. So therefore, that need to be addressed ourselves as to what happens to this extra area what you get. Will it be taxable or no? Added one more complication. If my calculation fits in, will I be eligible for 54? If calculation fits in, and will I be, suppose even if I am getting extra area, will it fit in capital gain arising? Is it taxable or not taxable? But if we take the view that is no capital gain, there is no transfer, then entire 50% will become taxable in your hands, but as a capital gain, but not as a income from other sources. So that's the point which we need to consider, that for your holding of land and building in the society, you are getting 1,000 square feet extra, and for which my view is only the cost of construction in the hands of builder, cost including whatever his extra cost is there, his cost will become our income, and that should be taxable as a long-term capital gain. Because if you are holding more than 3 years, that's a possible answer, and I think it's a defendable answer. I would say a defendable answer. That is number 3. Number fourth complication, just consider, generally builder gives a lump sum amount as a donation to the corpus. How it should be taxable and in whose hand should be taxable? I take a view, it should be assessed, it is for and on behalf of all the members. So therefore, gain, if any, should be paid by the members and not by the society. Because there are certain advantages to go under the members, because you may be able to claim under the overall calculation, you may be able to bring down the taxation much lower, instead of offering everything in the hands of society. Number three. Fourth, what happens in the case of a alternate accommodation provided or a rent paid to you for alternate accommodation? Let's take a situation of there is a brokerage, there is a 3 years rent paid to you, and you go and incur that expenditure. Fortunately, there is a Bombay High Court decision, recent Bombay High Court decision, which says what you get here as an inconvenience for within development period is not chargeable to tax. And they are held to be a capital receipt. How far it's correct, I'm not sure, but according to me, it is not taxable, because if you are incurring expenditure against that, suppose you are getting, say some X amount and you are spending the entire X amount, will it be taxable? According to me, no. Nothing is chargeable, because it is only alternate given to you during the period of this construction. One more dimension could be added. Suppose there is saving. You have another flat and you have gone and stayed in another flat and your entire amount is saved. Will it be taxable? According to me, it will be taxable. If Bombay High Court is to be said to be correct, then nothing is taxable. But I'm saying that's the point which we need to keep in mind. So therefore, these are the issues. Which one more issue which could be considered is, suppose there is extra amenities provided in the new society. Who will pay for it and whose hands it will be available? Suppose there could be a lot of new amenities because the entire property is developed. There will be a lot of new amenities are getting created. Will it be taxable or not taxable? Again, my view is no, it is not taxable. It is only the redevelopment of your area which is done by the builder on your behalf. And therefore, there is no transfer involved from him to us, and therefore that also is not taxable. So therefore, various facets are there, but again, I think each case need to be examined and looked into what could be the beneficial. We'll come to that later. End, if time permits. Or outside in the tea break. So that's a point which we need to consider. This is what we saw for residential. 54F calculations will have to be made. I'm not saying that, but you have to accept first principle whether it's transfer or not transfer. If you say not transfer, a lot of other questions get resolved, but if it is taken as transfer, what happens is there. So therefore, that issue I think we need to examine ourselves. If it is a commercial building or office building, what happens is another area which we need to discuss. There is no 54F, but there could be situation of section 50. And there could be many situations where there may not be depreciable assets in many of the hands. It could be just purchased and let out. Then it is section 50 is not benefit available to them. Neither 54F could be taken, because there's not what you are getting to is again office premises against the old office premises. So taxation situation could change in case of commercial buildings compared to the residential building. I think that's what we need to keep in mind. Now, capital gain is an evergreen topic. Again, you can discuss as much as you want. And again, at the end of the day, you find, take the toss and you will find answer could be some different in different tribunals. Again, I'm not saying that tribunals are wrong. Facts could be peculiar, but we go by the head note and we come to the conclusion that decision is in our favor. But when we read to the full decision, we say there's no difference between the earlier decision and this decision. Both are correct. So therefore, we need to be careful while applying whether 54 or 54F. And I'll just give you the broad. I will not get to the decision. That full decisions list is there with you. Purchase of property in joint name or in relative's name. Now this situation, what we are looking for is, suppose flat was in my name. I am buying a flat in the name of, say, me and my wife. Suppose wife name is only added as convenience. Will I lose exemption? That's the first. Suppose I buy only in the name of wife, not as a convenience, but completely for her name, what will happen? If I buy in the name of daughter and son-in-law, what happens? If I dot in somebody's sister's name, what will happen? So there are different permutations which is clear. So long as source is with me, I have invested my entire source of capital gain for the new flat. Though it is not in my name, will I lose exemption? What is the purpose of this section? Is to encourage reinvestment of a gain into another residential property. So if that is the intention, merely because I invested in somebody else's name, will it lose a exemption? That's the issue. That's the view taken by some of the courts as well as tribunals. But again, I'm not saying what will happen, I'm not sure. Again, I'm saying this is a question of a toss and what decision could be any decision. Second is under construction property. Again, this is a perpetual litigation issue. And again, facts are peculiar in every case. Take a situation, you have invested for 54 in the under construction property. Property is not complete. You completed everything, whatever you have to pay. You made a full payment. You did the registration. Everything is completed, but property is not received. Will you lose the exemption? I think that's the question which is there. Fortunately, we have Bombay High Court decision in case of Hilawadia, and which has taken a beneficial view, and that has been followed in many cases. They say as a owner or as a purchaser, what you have to do, you have done everything possible. It is not something that was known to you in the first day that flat you are not going to get in 2 years or 3 years' time. If that is the situation, you should not be denied exemption. That is number one. Number two, whether 2 years or 3 years is again very regular controversial issue. Depends on how agreement you enter into with the developer. If you make in the form of a construction agreement or give a color of a construction agreement, I won't say builders will change their agreement, but at least color of a construction agreement, you will get additional 1 year to at least reinvest in the property. So that's the point which you need to consider. Third aspect which many times we see, we invest in the property, keep paying the amounts, and we get a possession. Then we sell immediately. After we get a possession, we sell immediately. Will it be sale of a residential property or will it be sale of a real estate, interest in the property? So therefore, that need to be very carefully seen as to whether you are selling a flat. If it is a flat, is it a short term or long term? Because you got a flat only yesterday and you sold it today. Will it be short term or long term? Again, there are both for and against decisions, but we'll have to just carefully see everything is considered. And there is old, very, very landmark decision of the Bombay High Court in 121 and 122 ITAT, Tata Services cases. I think those cases need to be looked into carefully. And based on that, there are lots of other decisions which I have listed out here. Depends on facts of each case. You can examine where situation arises and where could be taken benefit of. Then another interesting case happened in case of a proportionate exemption. Suppose you sell the building and in the reinvestment you purchase a full sell the flat and take a house and you buy the entire building, which has a partly commercial and partly residential. Will you get proportionate exemption or lose the total exemption? And fortunately, we have one decision of Bombay High Court which has taken a view that you will get proportionate. But I'm saying I would prefer that your lawyer should be guided properly as to make proper agreement and not one agreement for the purpose of entire. It could create a litigation, particularly if it is a faceless. You will have a lot of litigation to happen and you will have senseless assessment in the faceless. So therefore, you need to be careful on that. Again, property situated outside India. Now this is more or less historical, but those who are already invested, you can take a benefit because they have said that there is no against view. I mean, there is no prohibition in the section 54 or 54F. But again, I'm saying this is a historical issue, but for the past cases, this could be considered. So I'm not spending more time on this, but I think let's move forward because there are a lot of other things to cover. And already everybody has guided me. They asked me, how long will you take? So I asked him, what is the time available? They said, so long as Ashok Sharma is there, you can continue because he's the last person who will leave the house. So keeping that in mind, I'll try to finish at least highlighting the issues. Now, this is another interesting issue which is coming, which is a very day-to-day difficulties what we face. As all of us are aware, real estate prices, real market value of the prices, assuming the 100% check transaction, and ready reckoner value never matches. in the same building, same area, you will find different prices happening, depends on demand and supply. Quality of building. So many things factor. Front side of the front side, west side, south side, whatever the sides are, depends on that the prices could change. Ready reckoner does not take into account all this except that floor rise or floor, what is that? That's the only advantage given, but otherwise there is no other differentiation made by them. In such situation, what happens? Because there are double hit on that you get. Seller gets hit, purchaser also gets hit. Seller gets hit on the 50C, purchaser gets hit on section 43CA. So how do, 57, not 56, 57, not 43C is for the developer. So that is the situation which we consider. Now, how do we protect ourselves for this purpose? Now, genuinely, you know that you are not paid any cash transaction. This is the fair market value on that day you have purchased the property. There could be several disadvantages to that. He must be a desperate seller, whatever could be the situation, but that's a fair market value on the date on which you purchased. Now, how do you justify that? There is a provision in the Stamp Act itself, you can go for adjudication. If you go for adjudication and convince all these factors to the stamp office, then that becomes a final price. That is a final ready reckoner price. I think that's what at least if somebody asks me, I'll say you do that. Even in my own case, I did that. So I'm saying all of us should do that because that helps you to avoid further litigation. Because if is not done, and for a reason that suppose purchaser is very keen to get it registered in his name, he says, I am prepared to pay the stamp duty, don't worry about it, you find your own matter, you fight your own battle. But I am going to pay and get property registered, because for him it is only whatever 6%, 10%, 8%, whatever the extra duty, that's his cost. But for me, it is a more risk for me for many other reasons. What do we do? Fortunately, there are recent trends of decision to show if you are able to take proper care and proper valuations at a proper time, including there is a provision in the section 55A read with 142A to refer to the district valuation officer. You have to convince him as to the date of when we purchase, what are the situations, what are the factors which affected the price or which is different than the ready reckoner price. If you are able to get that, at least you will be saved on that price. In the example of Delhi Tribunal decision, which is very recent decision, you can notice from the facts. Just highlighting for purpose, this is a regular case, regularly we face these issues. Property purchased for 5.5 crores, other property in the same area was 1.1 crore. His approved valuer valued at 5.36 crores, as against 5.5, 5.3 crores. Stamp duty value was 8.38 crores. When matter went to the DVO, he valued at 6.38 crores. So, tribunal said, when the other property, 1.1, that also had a different prices, which is in the same locality. Square peg-wise rate was completely different. Tribunal said, if the price is so much variation in the same locality properties, how can you say that which valuation is correct? Therefore, we disregarding all the valuations, ready reckoner value, stamp duty value, DVO's value, we will accept your value as a correct value. So therefore, you are avoided from all these hardships, but therefore you need to build up all those at the beginning when you are buying the property so that you will be at least saved from that point of view. And they have also said merely because purchaser has paid the full stamp duty doesn't stop you from being defending your case and avoiding whatever 50C applicability. So therefore, that also needs to be carefully seen. Another important point and another important decision which I had missed out earlier, but recently for some other matter we were studying and then we located this decision. There is a circular of the stamp office. If there is an auction of a property by particularly government authorities or courts, auction price becomes a ready reckoner value. And there the cases where bank auctioning the property or wherever there is properties are being acquired by the financial institutions or anybody else and they auction the property, they said what is the price which is then for auction, that will be the ready reckoner value. That's the correct price, and for that you cannot compare with the ready reckoner value. And therefore all the difficulties which are faced between the difference between ready reckoner value and auction price will be avoided. And invariably noticed, auction prices are lower than the market value. Because people feel that if it is auction, there must be some problem with the property. Or it is already acquired by the bank, acquired by so-and-so, the property may not be maintained properly. So therefore, the value is always down. So keeping all this in mind, tribunal has, there is circular has been issued and which has been accepted by Pune Tribunal and recently Bombay Tribunal also, that this is the correct price to be taken. So that would be the price for you to compare and not the ready reckoner value. I think that's an important decision to be kept in mind. Now, these are the set of issues or questions. I think again, full session could be devoted on what is 147 and aftermath of Ashish Agarwal Supreme Court. I do not know whether this was this platform or some other platform I said. Supreme Court said there are 90,000 cases pending on this, out of which 9,000 are writ petition. Therefore, to protect assessee and as well as the revenue, we are invoking Article 142 of the Constitution and holding some things. But the way order was written, it was far more complex and it has created a lot more complexities. And I'll just show you from 3 or 4 decisions. I don't think so we need to get into, or neither we have time to get to the decision. So much complexity has got created in that, and so much interpretational issues which CBDT has raised on that has created lots of litigations. Added to that was COVID period TOLA, what do we call it, whatever that exemption order or that extension order, which was immunity order was given. For certain period, they were given a certain period extension. They popularly known as TOLA. Added to that, this is another factor, whether that gets automatically period gets extended, whether the case is reopened. Just before we go to that, let's understand what Supreme Court said and what was the facts in that case. Supreme Court said, according to Supreme Court, to ensure the justice has tried to strike balance between the rights of revenue as well as the respective assessees because of the bona fide belief of the officers. Underline this word, I'll come back to this word again. Bona fide belief of the officers of the revenue in issuing approximately 90,000 notices. The revenue may not suffer, as ultimately it is a public exchequer that which would suffer. What do they do that? It has done so, modifying the judgment and orders passed by Allahabad High Court and several other high courts, making applicable, extending applicable to pan-India, and providing various high court invoking Article 142 of the Constitution. Now what does it say? And all these difficulties were in respect of notices issued between 1st of April 21 to 30th of June 21. Because as you are aware, the reassessment provisions were modified completely, overall completely, by Finance Act 20 with effect from 1/4/21, which was further modified into 22. Let's not get into, but let's restrict ourselves to 21. Department woke up and issued a notice between these 3 months, 90,000 notices as per Supreme Court's order. They did not get time earlier to issue notices. They issued all the notices only in this 3 months period. And all this, out of 90,000, 9,000 cases were in the writ petition pending before the Supreme Court. Now, Supreme Court was very charitable, saying that bona fide error of the tax officers, we should give credit to them or benefit to them, because ultimately you will pay for taxes for that, because they are not nothing to lose. They said all these notices we are validating. These notices, whatever 90,000 cases, we are validating all these notices. However, has not been interpreted or read by the tax officers, which is the litigation which is starting. However, they will follow all the procedures prescribed under the new act. These notices will be deemed to be the notices issued under the new act, that is 2021 as amended, and all the provisions which are applicable to the new provisions must apply. And they must give the reasons for whatever reasons they are recorded within 30 days to the taxpayers. However, the exception provided or benefit provided under section 149 must be adhered to. Now, Section 149 says, if the case is reopened for the earlier year, and if that case is becoming time barred as per law as stood that time, then you can't reopen now. And basically the issues came up for 13-14, 14-15 and 15-16. Because that's the time when 6 years periods were getting over. 15-16 was a border case, but 13-14, 14-14 was clearly out of 6 years. And if 6 years is not satisfied, then you can't reopen beyond 6 years because that's became time barred as per 149. This paragraph of Supreme Court's order has not been looked into, and department issued a circular in 21 and 22 to say that all the cases you should reopen, including 13, 14, 14, 15, 15, 16. And the litigation started. Now look at the two decisions which I'll just touch upon, which makes it, and those who are faced with the reassessment provisions, I will strongly recommend to read these 5 judgments which I have enclosed in the compilation. One is Delhi High Court. Delhi High Court said, again almost same like Ashish Agarwal, that 3 months benefit which is given by the TOLA, you should be granted to the officer, so therefore this is not bad in law. Therefore, if they have done something in 3 months, you should be permitted, and you should permit to reopen even 13-14 assessment year. That was Delhi High Court. Same was followed by Salil Gulati next case also, the both went on. When matter came up before Gujarat High Court in Kinara Industries, they said no, that's not the way we interpret the Supreme Court decision or the circular. Circular is bad in law. What they issued circular is bad in law, therefore that's not the correct circular. And they said that no, we are not accepting the view taken by Delhi High Court, and we take a different view. And they said these are bad in law. And their cases were between 13-14 and 14-15. And which, according to me, everybody was unanimous that it is time barred. Then the issue came up for 16-17. And that came up later on Bombay High Court, but before that Allahabad High Court. Surprising part of it is decision of Delhi High Court, which held that reopening is valid, where SLP filed by SSC was rejected by Supreme Court. Look at the implications. Decision which were against SSC, against which SLP was filed by SSC against Delhi High Court, SLP was rejected by Supreme Court. When these two matters came up before Supreme Court, Gujarat High Court and Allahabad High Court, which were favorable, and there are several other high courts, but these were the first two. Supreme Court granted a stay on that operation of that order. So one hand, we have against order, which has been, SLP is rejected, and favorable order, stay is granted by Supreme Court. Now we are stuck with these two situations. Now which is the correct law to be applied? Is it Delhi High Court or Gujarat, and which is already stayed? Matter came up before Bombay High Court. And these 3 decisions are very, very critical decisions, and which all of us should read carefully wherever we have to deal with 147 cases, and particularly the new act. Bombay High Court clearly said, nothing doing, this is not our interpretation. In spite of a stay granted by the Supreme Court, they proceeded with and said, even in case of 15, 16, 16, 17, we are holding that these are bad in law, reopenings are bad in law. There are 3 decisions. One is New India Assurance, Siemens, and third decision is of Hexaware Technologies. All of us read these decisions very carefully, very, very well-drafted decisions, and in spite of the stay granted, after considering the stay, Supreme Court, Bombay High Court said no, these orders up to 16, 17 are all bad in law. So therefore, according to me, there is still good hope. What will happen in Supreme Court, we do not know. If the same type of approach is taken like what is done earlier, same type of approach is taken earlier, we do not know what will happen, but at least there are 3 decisions of the Bombay High Court, all in 23 and 24, and very, very detailed, reasoned decisions. So I have good hope, at least up to 15, 16, definitely all cases are bad in law. 16, 17 is borderline case, depends on when it was reopened. If it is not reopened in six years' time, again that will become bad in law. So therefore, keeping in mind, we must examine these reassessment cases. Hexaware also has laid down very, very important principle. Hexaware, Siemens, and that New India Assurance has very important principle. As you are aware, to extend the period from 3 years to 10 years, there has to be certain other conditions to be satisfied. There has to be asset, income, then there has to be entries in the books of account, something has to be there. Question was, I have claimed some exemptions. Suppose under 10A exemption is claimed or 80ZA deduction is claimed. Will that amount to falling in that category of expenditure, income, asset? Bombay High Court said no. Claiming of exemption or rejection of explanation cannot fall in that explanation, so you cannot extend beyond 3 years. So you are benefited again by that interpretation given by Hexaware, and they stopped at saying 3 years only, not beyond 3 years. So even 16, 17, 16, 17, 18 was become time barred because of this, because 3 years period could not be extended for that cases. So that again is interesting as to, it is not only the period of 6 years, but 3 years, if you want to cross beyond 3 years, you need to satisfy some more conditions which are not getting satisfied. Now this is a slightly different topic, but I thought this is important for us to know, and which is the problem which all of us face. Now notices or orders are served on you through ITBA portal. Rarely these are sent through email to the taxpayer directly. Many times the addresses or email IDs are changed, because what happens is, we have noticed is, when the returns are filed, generally the tax manager's email ID is given, not the company's or any other email ID, because not to get notices lost, it is given to the particular person. That person has transferred, or his person is not with the organization. When the notice comes, notice is not traced. What is gone in ITBA portal, unless you track on daily basis, you can't really know. In such a situation, what do we do if the notice is served on the ITBA portal? And this is the order, it says, and this is a very, very detailed decision, Sumanji's appeal as to what circumstances notice is deemed to be having served on you. And there are 6 or 7 categories they have mentioned. We will not get into all these categories, but they have said physically if it is served, it is to be treated as when it is actually given to the post office, which is the historical Supreme Court decision. When it is given to the post office, he becomes your agent, and that's the date of service of notice. If it is by the email, they say it must be uploaded on the portal. Time of uploading becomes important, and that evidence has to be given to the taxpayer. This is the time I have uploaded. Because what happened in many cases, notice dated 31st has been uploaded on the 1st of April. Court said no, this is the time barred. Because you have uploaded, because that whatever the data immediately throws out, it is uploaded on the 1st of April. Some cases is uploaded at 2 o'clock, early morning 2 o'clock, not on 31st before 12 o'clock. They said it is bad in law. So therefore, it is very important for all of us to examine the time and date of service of the notice. And again, I always tell everybody, please keep track of your emails and portals, regular verification of portals, because what comes in the portal, if you don't track properly, this could create problem, and notices will get unattended, and it will be ex parte orders will be passed. Now, other points, I think important points need to be considered is regarding the stay of demand, which is a problem which all of us face. There are 2 good decisions. One is of Delhi High Court, and other is Mumbai Tribunal. I'll just give you the broad principles. As all of us are aware, as per the department circular, if you want to contest the matter in appeal, you need to pay 20% of the disputed tax. And Nihar Bhai was referring to, or some query referring to about penalties, whether out of 3 matters, 2 are rectification, 1/3 is not rectification, what happens? Whether that could be recovered or not recovered. And this could apply to even this type of situations. Now take a situation, there is a demand created, out of which, out of the 5 issues, 4 issues are rectifiable. Either credit is not given, 26A is not matching with your tax payments. So there could be 4 issues on which demand could be different than what is actually there. Disputed could be only 1 issue. Question is, can the department say, no, you must pay 20% to get a stay, otherwise we are attaching your bank account? Courts have taken a view, no. First, you must address to the rectification application. Attend to the rectification, attend to the stay application asked for by the SSC before you invoke 20% category to be invoked. And you can't attach that bank account like this. And this was, again, National Association of Software Services. So very detailed decision Delhi High Court has given. So therefore, whenever you are confronted with this type of decisions and this type of circular, there is also Karnataka High Court decision in case of tally. That also is almost on the same lines which has been followed in this case. They have also explained 20% is only general category, general criteria. Does not mean it is a mandatory. This is circular. Section doesn't say that you must pay 20%. It is not something like a GST Act or any act that you must pay 20% to go in appeal. This is only indicative. Take a situation that in your case, entire addition is covered by your earlier order. Can you be forced to pay asked to pay for 20%? Court said no. Like a rectification, whether stay of demand, which is covered by your own orders or jurisdiction High Court or Supreme Court order, can you be asked to, forced to pay 20%? They said no. All these factors has to be looked into, and for which officer must adjudicate on the stay application where what we have mentioned. So when you move stay application, please ensure that you mention all these factors before him. It could be helpful. If the demands are large, if the officer doesn't agree, you may have to go to the High Court in the writ petition to get a stay of the demand. Because unless you are in the tribunal, because if you are before stayed appeal, nobody will give the stay. You will have to be forced to pay 20%. Otherwise, they will attach your bank account. So therefore, in such situation, you may have to go to the High Court to grant a stay if the amount is large. Other interesting issue which came in our EBS case is how to work out 20%. Now, calculation, normal course, we go by the presumption, whatever is shown in the notice of demand, we must pay 20%. But that's not the case, really correct case. Let's take a situation, you have filed a return, say for 1 lakh rupees, and you have claimed certain exemptions, and because of which you are entitled for a refund as per the taxes paid or TDS. So they say, let's assume that you are entitled for 50,000 refund in that case. Officer rejects your exemption application, rejects exemption, because of income becomes 5 lakhs rupees. And tax demand becomes, say, 2 lakhs rupees. As per officer's calculation, you must pay 20% of 2 lakhs rupees, that is 40,000 rupees. Tribunal says 50,000 is already paid by him. He has paid more than 20% already. Where is question of asking him to pay additional amount of 40,000 rupees something? While calculating 20%, whatever is excess payment made at the time of return, amount refund due to you, that must be taken into account for calculating the 20% as a payment made by you. And they have also gone to the extent of saying, in such situations, you cannot adjust the refunds without giving opportunity to the taxpayer. And invariably what happens is a mechanical way, 245 orders are passed without you knowing the refunds are getting adjusted. So even if 50,000 refund is there, it must have been adjusted against your earlier some demands, and then this year it will show that there is no refund due to you. So all these cases, they say unless you complete the process, you cannot make any adjustment of this. So therefore, that need to be carefully looked into. Now friends, I'll just touch upon the decision, and because those who are dealing with international tax cases or those who are going transfer pricing cases, I think this becomes a very important decision, is the case of a Roka bathroom, and which is also shell drilling, their Bombay High Court decision. What was the issue was, Section 153 gives the upper limit within which you should pass the order. Section 144C has been brought in case of transfer pricing cases. If your case is referred to the transfer pricing, then they get extended time. Issue came up as to whether this extended time has to be completely done within the 153 upper limit. And Madras High Court and Bombay High Court said 144C cannot extend your time limit. It has to be completed within 153C, 153 section itself. And therefore, all the cases, wherever this time orders are not passed within time, has been held to be bad in law. So therefore, you need to check up all your cases wherever the situation has happened, whether the orders are passed within time or no. I think that's what we need to check up. Unfortunately, this also matter went to the Supreme Court. Supreme Court has granted a stay on this operation. therefore, all the matters which are pending in litigation are again stayed, because they say we can't pass order because Supreme Court has stayed the matter. So therefore, whether it's CIT appeal, that CIT got additional excuse that they don't have to pass such orders because they anyway have not to do, and plus tribunals have also kept everything pending. Now, this is another issue which is again DIN issue. I do not know, I was not aware of this complication till I was faced with arguing for litigation matter. Each of the, and I will read the circular, which is very crucial for us to understand. I was told this circular has been issued at the behest of Prime Minister Office and 2019. And read the wordings, what it says is, second para, in order to prevent instances of communication being issued manually without maintaining proper trail, all communication issued by the income tax authorities relating to assessment, appeals, orders, statutory otherwise exemptions, inquiry, investigation, verification of application, penalty, prosecution, rectification, approvals to the assessee or any other person from 1st October 19 shall bear a document identification number. Many times I have noticed DIN is not on the notice or order. It is separately issued either on the same day or after few days. And many times our teams don't really look at that, and these mistakes are being regularly happening. Courts are saying if the DIN is not on the order, then order is bad in law. Even if notice, approval for reopening or anything, everything has to have the DIN number. If we don't have the DIN number on that and digital signature below, orders are bad, all orders, notice, everything is bad in law. So therefore, this is again very, very interesting decision, Brandick's decision of the Delhi High Court. Unfortunately, again, it is stayed by the Supreme Court. We'll have to wait for the Supreme Court to decide. But I'm saying this is the way we need to analyze all these procedural matters, and which courts have taken a view that you must look into seriously. It is not something which can be taken casually. From 19 to 24, or 19 to 23, 4 years you have not understood how the circulars to be interpreted, then we can't give a liberty to you to take that bona fide error, like Supreme Court did. We are not here to do what Supreme Court said. And they are squashing the orders. But subject to this now recent stay, they are not been able to post. But I'm saying we need to be careful in seeing that every document comes from a department is with the DIN and digital signature. If either of things are not there, orders are bad in law. Now, since Nihar Bhai has already taken, I will not deal with. Only one point I just wanted to know is an interesting issue which has come. One is, I was not aware that 26AS gets updated regularly. I was not aware, till I read some of the recent decisions. This is one of the decisions says, when I filed the return, this was figure matching with my return. 26AS, my return was matching. Subsequently, before he passed the order, there is variation in the 26AS. So he picked up the last 26AS figure. And he says there is a difference between your figure and this figure. Therefore, I am treating this as a under-assessed or whatever the two words they are using, that they have said, therefore liable for penalty. The tribunal said no. We have to see the situation, what was there on the day when he filed the return. If it is subsequently modified, subsequently 26A is modified, and which assessee may have overlooked, possible that we may have overlooked what is updated subsequently 26As. That cannot be reason for levy of penalty. And even under the amended law, not in 271C, it is under amended law as to whether it could, they say may and shall continues to be even 271A also. So therefore, they said that is need to be considered. Second point, he was a central government employee and there were a lot of transfers within that departments. Question was whether 10 lakh gratuity exemption or 20 lakh gratuity exemption, and which he made an error in that. They say even if he's made error, you can't penalize for that purpose. Again, they said may has to be looked into. Therefore, there is no intentional default made by him, because at a particular point of time, he was employee of a X organization, then he became, because of government organization, became private organization, so limits kept changing. So they say that can't be reason for levy of penalty. So therefore, this type of situation, particularly 26AS variation, I think very, very interesting, and we should keep track of that. This Prem Brothers, which I was saying, if there is no tick mark whether it's misreporting or underreporting, then penalties are bad in law, which Nearby was mentioning. I told him later on, this is a recent decision we must keep. You are aware that under 271C, there is a decision, including up Supreme Court, that furnishing of inaccurate particulars or concealment of income. In the notice, you have tick mark. Officer is supposed to tick mark. He can't even tick mark both. He has to tick mark either which is applicable to you and do accordingly, and otherwise Supreme Court said no, that is not valid. There is no application of mind by the officer. Same is the case now. They have started invoking. You have to mention that it is either misreporting or it is underreporting, because there are consequences of what is the exemption, immunity which is available for us to go for paying some amount and closing doesn't apply in case of a misreporting. So therefore, that is important. I have noticed recently they have started saying underreporting of income led to misreporting. Now, underreporting of income which led to misreporting. Now, they are trying to cover both in the one example. According to me, is wrong. You need to be clear whether it is underreporting or misreporting. Otherwise, that notice or order both is bad in law. And just to, he was referring to draft order versus final order. What is required to be there is, even if it is not there in the draft order, but is there in the final order, I think that is sufficient. Because draft order is only proposing. Additions may get completely negated at the DRP level. So that is not the stage at which really penalty proceedings are initiated. Penalty proceedings will initiate only when the DRP finalizes. This is what is the final addition which is confirmed. Then only it can happen. Now, prosecution, I do not know nearby covered or no, but prosecution cases, there is a host of decisions where prosecution could be done or cannot be done. And I think each of the case must be looked into very, very carefully. And wherever is possible, I would recommend go for compounding, because the amount of harassment happens once it goes to small causes court is a tremendous. Now, question is, if there is a bona fide reasons for not being able to pay the taxes, whether it is a self-assessment tax or any other tax, courts have taken a liberal view. And they have said, in such a situation, and particularly these are COVID situations, they have said that prosecution cannot believe it. And there are good cases, 2-3 cases, but if some of the cases are stuck with this, I think you should be able to take the benefit of that. But there are against decisions also, particularly if the tax is deducted but not paid, the courts are very severe, and they said no, even that can be prosecuted. And there's the host of decisions I have quoted that can be looked into. Now, I will take last 2 minutes or 3 minutes. This becomes a little interesting, and those who are dealing with some of the taxpayers who remit the amounts abroad for various services being obtained by their clients, and certificate 15 CACV, what are the certificates are there, those are to be issued by chartered accountants. For that purpose, whether this becomes important. Now, what happens is many times, like testing and certification charges are paid abroad, and which is what a very normal. If you are exporter, your goods are to be tested and certified outside, and you have to enclose the certificate along with your export documentation. Now, question is, you may be paying to the treaty country. In this case, it was USA. But the testing work was done in Hong Kong. I am talking about old case now. The Hong Kong also has treaty, so it was done in Hong Kong. So whether treaty will apply, US treaty will apply or Hong Kong treaty will apply. And that is the issue came up before Gujarat High Court. Gujarat High Court said, your contract is with the US party. Whether he gets it done from Hong Kong or XYZ has no consequence, because ultimately you are making a payment for the contract entered into by you with the American company. And therefore, US treaty should apply. And you will find this many cases, most of the contracts are with the parent company, but services are entered by Asian countries, like whether Philippines, Bangladesh, whether it is Singapore, Malaysia, everywhere. Services are, because they have service center, all these companies have service center, and services are rendered from there. So always issue arises which treaty to apply, whether that country's treaty to apply or main country's treaty to apply, and therefore this decision becomes very, very relevant. And after considering that, you have to see whether there is any make available, and whether that you are eligible for direct tax or not direct tax, because make available is a very crucial aspect for the purpose of these provisions. The next decision is regarding subscription fees, and which again very regularly I would say defaults are committed by us. Without application of mine, tax are deducted or not deducted. Both situations are happening. And you need to be careful while remitting the amounts which are done, which country you are done, which treaty is applicable, not applicable, need to be examined before we come to the conclusion. Also, word of caution, many times we don't look at or seek PE certificate of the foreign party in India. Most of the parties have PEs in India. If PE is in India, the treaty doesn't apply to you, then it has to be based on the basis of you have to pay the full taxes because they are liable as in India. So therefore, before issuing certificate, please, as a word of caution, please have a look at the entire facts put together before you issue a certificate, because ultimately you will be held up, not the SSC. You will be forced to be held up because you issued a certificate of 10% tax or whatever tax, no tax deduction certificate. So therefore, that need to be looked into. The last decision I would like to touch upon is Bharti Hexacom. According to me, is upsetted the entire our knowledge about capital versus revenue, what we learned from Alembic case 77 ITR till today, as to when a payment is made for user of anything, whether it is revenue or capital. All along we have been saying, if its payment is made for any user of any services or user of licenses, it is a revenue expenditure, it can't be treated as capital. But the way Bharti Hexacom has analyzed the telecom payments is something very, very disturbing. And I am really disturbed with the way this decision, the way it has been written, the decision has been written. Only saving grace is the last line, which I like to read. When review petition was filed, what they said was, subsequently order dated 17 May 24 held that the payment of interest for the period for which the tax demand is now being met, to be met in respect of these cases stands waived. Because of the revenue expenditure is treated as capital expenditure by Supreme Court decision, they say we are only waiving with the interest. Review petition, instead of reviewing the entire order, they have only given you the waiver. That's the only saving grace. And one more line they have added. Supreme Court held that this order shall not become a precedent. Now, what is not precedent? A precedent, I don't know. Supreme Court is under Article 141 is binding on everybody. Now, if you say that even services rendered or user services is also liable for capital, is treated as capital expenditure, how could that not be precedent? And they have said, and this should not be used as a precedent. So therefore, such interesting aspect when we see, when we analyze certain decisions, we get certain interesting aspect to see. And decision, again, not very useful decision, but I think very interesting part which Bombay High Court has recently said, Exis Industries case. Writ petition of 2009, challenging the reasons recorded for search, authorization memo and reasons recorded search was challenged in the High Court in 2009. 2024, there is a search is bad in law. I don't know what will happen, but the last line is, they have said that whatever material collected, you can use it now. So 2009 to 2024 writ petition was pending. 24 is get decided and say that search is bad in law. However, you can use the material. Now, who must have waited from 2009 to 2024 for this corporation? Friends, thank you very much for giving us time, and the organizers for giving me time for